Welcome to the Jones Zone, a podcast by Darryl and JJ Jones.
Hello, everybody. Welcome to another episode of the Jones Zone. Today, we've got Jim Zers. He's a reverse mortgage specialist. Huge product that's sold today in the market. It's very useful. I've come across people that it would be very, very useful. Let's just dive in with what is a reverse mortgage? Where's the word reverse come in? Explain that to the audience.
Let me give you my real quick, what I call my reverse mortgage 101. Only takes
Sure.
a minute, and it definitely includes how we get the term reverse in the name reverse mortgage. So reverse mortgage is a loan. What it does is a reverse mortgage, it makes available a certain percentage of a senior's equity to them. Okay. And it's you qualify for that based on your age and a little bit of your credit score, not as much as a regular loan. And the main advantage to it is that a reverse mortgage allows you to take the equity in your home, take out what effectively is a loan based on a percentage of that. And the big difference, the big advantage is there's no mandatory payment. So every loan that you have, other than these, at least most of them, hey, I'm going to get a loan, I'm going to buy a house, I'm going to get a line of credit, I'm going to buy a car, whatever it is, you get that loan and you're going to create a payment, right? And with most mortgages, that payment is, 30 years, car loan, all those things involve payments. So the big advantage and the difference is that with reverse mortgage, it allows you to take your home, and it's only a home loan, okay? Takes the equity in your home, and it's like, that's a hard asset, right? Your house is a hard asset. You can't buy groceries with it, whatever. But it takes a portion of that hard asset and turns it into an asset that you can use, a liquid.
Like a stream of income. A stream of income.
One of the things, absolutely. It takes the part of the equity in your home, turns it into a liquid asset. You can turn it into an income stream. You can pay off an existing loan. That's what's huge, because lots of seniors, baby boomers and such, retired, and they have a mortgage, right? So the cornerstone of a well-planned out financial plan, if you talk to any financial planner, you don't want to have a lease payment. You don't want to have a mortgage if you can avoid it. A lot of people have that. So one of the things that people do with reverse mortgages many times is they will have an existing balance on a mortgage. And Darryl, I'll see people at 65, 69, and they've got 25, 30 years left. I mean, not 30, but they have 20 years, many times 20 years left on their mortgage. Guess what? They'll never pay that off. They're going to live with that payment unless they sell a house. So what a reverse mortgage can do, if the person qualifies and things like that, is it can pay off that mortgage and eliminate that mortgage payment.
So payment, from having a payment to zero, not only getting zero income as well most of the time, correct?
Well, it just depends. It depends on the balance of the loan, the age of the person, and the value of the home.
With home values skyrocketing the last 5 years, I'm guessing there's going to be a lot of people that are qualified to do this, right? I mean, the value is a huge part of it.
That's correct. It's like any other loans, there are moving pieces. And of course, now we see that the interest rates are higher than they used to be, right? So with home loans, for instance, standard home loans, what happens when the interest rates go up is your payment goes up.
If it's not fixed.
Right.
Yeah.
But I'm just saying, if you go and buy a new home.
Yeah.
Let's say I've called Darryl Jones and I want you to find me a home, right? What'll happen is when I need a loan to buy that home, the amount that I can buy is going to be dependent on my monthly payment. So in a higher rate environment, that payment's going to be higher than it was, let's say, in 2020 and 2020.
Sure.
Right? So that impacts reverse mortgages too. Since there's no payment, what happens is if we're in a higher rate environment with a reverse mortgage, people will qualify for less. So you're absolutely right with the values of homes going up. People are going to qualify for more, and that's great. But also it has to be considered is the fact that currently the rates are higher, and it's tied into the bond rate. A lot of my clients will go, well, the Fed's increasing the rate or decreasing the rate, whatever, and those are short term. These loans are dependent on the long term rate. So that is kind of the fundamental. It's really not a complicated loan, and there's a lot of confusion. There's a lot of misunderstanding about reverse mortgages.
Well, we're going to clear up all those misunderstandings on this podcast.
Absolutely. So what happens then, Darryl, is you say, well, Jim, we've got this lender and and I'm a broker and I have access to like 6 or 7 lenders, so I can select the best and all that kind of stuff. So how does this thing get paid off? When you think about it, this lenders might be giving a senior $300,000, $400,000, $500,000 or more. They're not getting a payment.
They can have two options, meaning they can either get a lump sum or they can get monthly payments. Is that how it works?
Well, there's actually, I would say there's 3.
Okay.
So you're right. So they can get a lump sum up to a certain amount. Okay. They can get monthly payments, or the most attractive, and 99% of my clients, if they don't have to pay off an existing loan, right? What they'll do is they'll get the option. It's a line of credit. So what that is it's similar to a HELOC, except there's no payment. That's great. What HUD has done, because the FHA loans are insured by the government, in effect, is what they'll allow you to do is you could set up this line of credit, and the amount of the line of credit that you don't use grows over time. There's actually a growth factor. So example, let's say I've got a client, they have to be 62 or over. So
62 years old to get a reverse
FHA loans.
To get FHA
loans.
Reverse mortgage.
Non-FHA, I can go as low as 55.
All right. That's an important
categories: FHA loan, non-FHA loan.
Got it.
So we're going to talk about the FHA loans because they are the most popular.
Why are they the most popular?
They've been around the most, and actually reverse mortgages were created like in the 60s. And it was during the 80s that the Reagan administration, seeing that a lot of people retired house rich but income poor, right? So they saw the value to seniors of taking equity in their home, being able to turn it into funds that they can use now. And back in 84, 85, whatever, at that time frame is when the FHA, when HUD made them FHA insured. What that does is that insures the lender that in the event someone doesn't make their payment, that the lender will be made even.
I don't want to confuse people, because they don't have a payment when they get a reverse mortgage, right?
So how do these things get paid off? FHA loans are more popular. They've been around longer. They fit most of the values of the properties that you see now. These non-FHA loans only came in most recently to address a situation where a property was like $3 or $4 million. Because right now, in FHA loans, the maximum amount that the loan will look at is like $1,075,000. It's a little bit over $1 million. So if I got a $4 million house, that doesn't have a lot of value for me. So that's where a non-FHA loan play. To answer your question, FHA loans are most popular because they have the most features. Line of credit we're talking about that grows, the part that you don't use extra grows. That's an FHA feature. The non-FHA loans have something like that, but not nearly as attractive. Let's
talk about that. So 62, and then maybe is it a better strategy to get one when you're 62? Don't even use it for 3 or 4 or 5 years until you really, really need it. Is that something that's done?
Well, you can do that. And there are some of my competitors that have the approach that get it now because you may not get it in the future. I don't agree with that approach because there are expenses involved. There's a balance. What your question goes to is, how does this loan get paid back? And where does the term reverse mortgage come in? What happens is the bank could give a loan and not see money for 20 years, right?
Right.
They gave me a loan. I lived for 20 years and I could live to be 120. Of course,
God, really? That'd be nice.
Security, but I'm not going to go there. So there's no payment. So what happens instead of making a payment, because every loan in the United States has interest, right? That's just the way they work, is instead of you making a payment every month for the rest of your life in a lot of cases, what happens is that interest is added to the loan. So what happens is the loan balance over time is increasing. Okay, so this is a loan that starts
on the reverse mortgage.
So yeah, with a reverse mortgage.
Yeah.
The reverse mortgage, no payment, interest is added to the balance of the loan.
Right. So you start off with 500 and go ahead. I'm sorry.
Yeah, no, you're heading the right direction. I could start off with a $500,000 loan. 20 years later, it's $700,000. Where they get the reverse mortgage is, I'm going to try and do it with my hand so people could see, is when you buy a 30-year normal mortgage, over time, you're paying off the interest and then you're paying towards the equity, right? So 30 years later, it's doing this. What's happening with the reverse mortgage is
reverse your hands.
You're not making that payment, so it's doing that.
Right.
Okay. So it is going up over time. So that's one of the things that anybody interested in this, and absolutely call me. I can help you, determine whether these make sense or not.
Yeah, because
My
they're not for everybody.
Absolutely not. My approach, and I was going there, is some of my competitors get one now. I don't agree with that. It's for certain people, this is a great financial tool. For other people, it doesn't make sense.
Yeah, I had a gentleman, friend of a friend, who had a million house worth around 1,400,000, I think owed 100 grand, didn't have any income. And he was 70 in his 70s, and he didn't have any heirs either. Nobody to
Oh,
leave the
that's
money to.
perfect.
And there you go. That's like the perfect candidate for a reverse mortgage. Tell me what the negatives would be.
Yeah. So there are actually four negatives, okay, or perceived negatives. I'm going to say three are probably perceived. One is I call it more of a trade-off than negative.
Yeah.
And we're talking about that right now. So the first one is the bank owns your home. Now, a reverse mortgage is a lien on your property the same way that any other loan is.
That's a perceived negative. In other words, the
Perceived
bank does
negative.
not own your loan.
Right. It
Okay.
does not. It's the
Correct.
same. So if you get a reverse mortgage and you pay off an existing 30-year mortgage, you're replacing a lien with the current lien with a new lien. Okay. So that's the perceived difference. Second one, the bank can take my home. Okay. Now,
So it's a perceived negative.
there's a negative.
Okay.
So there's both. The perceived negative is the bank. When I die, the bank takes my home. That's the main one that I see. Oh, well, I'm not going to leave anything to my kids because when I die, the bank takes my home. No, it doesn't. Like I said, it's a lien. You got to have a trust. I'm a big advocate of trust.
Oh, yeah.
70% of people don't have trust.
Yeah. It's a
So,
no brainer.
yeah. So what would happen then is with the reverse mortgage, no matter what the balance is, when the second, let's say if we have a couple, just like anything else, when the second person dies, then the trust comes into play. And then this loan would be treated just like any other loan. So if there's, if you got equity and the loan balance and you decide to sell a home, which most people do, you sell a house, pay off the reverse mortgage, and now the rest of the equity is yours.
What's the time period? I think is it 6 months a person has to, the estate has to sell off that property typically?
Right. So it used to be flat out 12 months. But what they found is people who inherit the home would either forget about it or wouldn't get around to doing anything. So they shortened it to 6 months, and then you can extend it for 3 and extend it for 3, as long as you're showing the lender, hey, I'm trying to sell a house.
Now, let me ask you this. So if once one passes, that check stops coming? Because I had a client actually who recently sold their house, and they actually were very motivated because they talked about how their loan balance kept going up because their grandma had a reverse mortgage. And I didn't ask them. I guess I could have or should have, but nobody else can get that money. In other words, the heirs don't get monthly checks once someone passes.
No, they don't. Once someone passes, the lender will find out, they're notified. And then what's going to happen is the lender's going to want to know whoever inherits a house. That's why you have to have a trust.
Probate. This just occurred to me. Forgive me, but because probate sometimes takes a year or
Bingo.
2 years.
And guess what happens during that year or two? That balance is going up.
That's
why it's so important to have a trust, not for only all the other reasons, but for a reverse mortgage.
Reverse mortgages, they don't necessarily require it, but I'm guessing you recommend it to people. Fair to say?
Yeah, no, you can close these as individuals. They're not required to have a trust, but it's highly recommended. It's not required that you have a trust by any means, but with reverse mortgages, like I was saying, it's extremely advisable and so much cleaner that you have a trust.
A lot of people don't realize too, because I've been a big advocate for trust, because oftentimes folks think, well, it's going to cost me money to go set up a trust. And I'm telling them your heirs are going to pay so much more money if you don't have a trust in holding costs going through probate that, okay, you're right. It might cost you more, but it's going to be, if you really want to help your heirs, you got to get a trust set up.
My parents had a trust. I had personal experience with that. Unfortunately, my mom passed and my dad passed away like 3 months later. They're in their 80s, and I was the trustee, and they had 17 different ways that they wanted their funds distributed. So it made it so much easier. I could take over and I could manage that. I do advise that you have an attorney at the time, because as a trustee, you have a fiduciary responsibility. right? So you have to understand that.
We have a show on trust, and so
Do you?
look for that,
Okay.
everybody. But I'm sorry, Jim. Go ahead. Proceed.
Sure. No, that's great. And the lender finds out that a person's passed, then they want to hear from whoever inherits a home. They're going to reach out and they're going to say, okay, we know that your loved one passed away. What are your intentions?
When you do a reverse mortgage, do you designate to the lender and say, hey, look, here's the contact person, meaning the heirs?
Not at the time of doing the loan.
Oh.
What happens is the way it is vested, right? So if it's vested as individuals, is it's vested as community property? If it's in a trust, then it's going to say, okay, there's a trust. In the paperwork, they do have a contact, like,
Okay.
They ask for a family contact, something like that. So that's typically where they would go to say, okay, hey, how are you guys talking about that? That person may or may not be in a trust, for instance, right?
Okay, right. But they do get a contact.
Yeah.
They do get a contact person.
Yeah. The problem is if there's no contact person, then it goes through the whole probate. I've seen where that can cost $30,000-$40,000, right?
Oh, yeah.
It goes to attorneys that the state provides, and there's all these set costs. So when, to get to your point of, it's going to cost me, it's so much more cost intelligent to pay for the trust rather than have these costs for probate. One example, it was a family member of my wife's, and she paid like 40 grand just to go through probate, where, a trust can be 3,000 or less. That's kind of unless you have more assets and it gets complicated, things like that. But that's kind of the way you should look at it. If I didn't want to pay a trust, boy, it has a huge payback for the ones that you love. So the first one, bank owns your home. Okay, no, we know that. Not any more than any other lien. Second one, the bank can take your home. Now, in this case, what used to happen is if I was, and this happened, 15, 20 years ago, it used to be that if I am 69 and my wife is 55, I can get a reverse mortgage, but she's a non-borrowing spouse. What would happen then is, let's say I died, she's non-borrowing, she has to pay the loan off in 6 months, right? Well, guess what? She's a homemaker. She can't qualify for a loan. So she would have to sell the house.
Ouch. So the remedy is to wait till she qualifies to and get it. Yeah. Okay.
And what happened, and this is
Mick Jagger would have a long wait.
Prince had no trust. And it's a nightmare. Everybody came out of the woodwork saying that Prince had promised them money. So what would happen is my wife, not being 62, would be in a position where she was forced to sell a home. So Diane Sawyer, remember her? She was on 60 Minutes.
Newscaster, yeah.
Yeah. So they do a 2-minute blurb on this couple in Indiana, and they show the picture of this cute little house, in the country. And she goes out there and she basically says that because the wife wasn't 62, was a non-borrowing spouse, that they had to sell the house. Darryl, unbelievable. That hits, the country. The reverse mortgage can take your house. And that triggered Bank of America, Wells Fargo, and a couple other banks to get out of the market. That's how negative that whole message was and how it resonates. So that's where.
Do you mean the media misled people?
No, at the time, that was actually correct. But what they didn't tell them is that
wait a minute.
Let
me back up.
All these documents. I understand. I'm not a non-borrowing spouse. I understand. So that was where that came from. Now, since then, what's happened, and this is, I don't know how many years ago.
A while back,
is if I'm married to my 55-year-old wife, what happens is I qualify based on her age. She's a non-borrowing spouse. And in the event I die, she now gets, like community property, she now can maintain the house. And the loan continues to grow, but she's not being kicked out of the house anymore, in effect. And what they're doing, which is people don't realize, they're actually now going back on a case-by-case basis. So if you have one of these, and they're getting fewer and fewer as people age out, but if you have one of these loans and you're in a situation where you'd have to get forced to sell, they're actually going back and remedying that. Okay. So that's basically not, it's a perceived negative now.
So you really just want to make sure that both spouses, your wife and your husband, are both on the loan.
That's the best scenario.
Yeah.
Is they're both on the loan 62 and over. However, in certain cases where, it makes sense, And I've only done, I just did like one of these, and I've been doing this 11 years. I just did one that was a non-borrowing spouse, and I don't like them. Now, one of the things you can do, we'll get an insurance policy, right? Well, then when I die, the insurance policy pays off the loan. But now that's not an issue anymore because they have changed the guidelines. And that's one of the messages here is that a lot of these still perceived negatives over time, the government has changed the guidelines to address them to make this a better product and a better fit for more people. Okay, so those are two of them. The third one is reverse mortgages are expensive. And the answer to that is it's a relative cost. There is a mortgage insurance premium that's included with the reverse mortgage and FHA reverse mortgage. And there's a small one annually. So yeah, compared to a loan that does not have an upfront mortgage insurance premium, which same PMI, right? Same idea. Yeah, they're more expensive, but it's all a matter of, is that worth it to you or not, right? So it's relative. And I'm always upfront. Here's all the information. My approach is I give my clients all the information they need so they decide if this is a right loan or not for them. Now, the fourth one is what we talked about. I consider this more of a trade-off than a negative. So the advantage that we have, what we talked about is getting a loan, is that I can take money out of my bank. It can change my life. Darryl, I love what I do because many times this changes people's lives.
Oh, I could only imagine. Yeah.
Because when you're in a fixed income, you're retired, and you are barely making your bills. And I have clients that, you know what, old school, they'd rather make a mortgage payment than have a meal, right? Because they have that old mentality. Hey,
they need to get a better restaurant.
I make a commitment, I'm keeping the commitment. So these things can change people's lives. In exchange for that, because the loan's doing this over time, the impact is when they die, whoever inherits the estate is going to inherit less on the property than they would otherwise.
Yeah.
That's a trade-off. That's one of the first things I learned early that I explain and make sure people understand. And I say, well, how do you feel about that?
Really good for people that don't like their kids.
Don't like their kids? Or that example you came up, if you have no kids, you don't have any heirs, why not? There's no reason in the world not to do this.
Without a doubt. So let's go over a hard number. How do they figure out how much they get per month? Let's say someone said, hey, I want to supplement my income. Like you just said, I'm having a hard time paying for meals. And how do they figure out that? Is it based on the price of the value of the house? Mm-hmm. Is that it? I mean, if they have a $5 million house and they owe nothing, how do they figure that out?
Three factors that play into it. Number one is, like you just said, the house. Okay, value of the house. If you're in the 1.5, kind of like the, in California, and these are national numbers that drive these. If your home is like 1.2, 1.4, something like that, in many cases, the FHA is the better loan. So what happens? So it depends on the value of your home, and there is an appraisal that determines it, right? So we project it, and there's an appraisal. The second thing is how old you are. The older you are, the more you qualify for. So at 62, I'm going to qualify for a certain amount. If I'm 80, I'm going to qualify for significantly more. Okay, so that's involved in it. And then the other thing that they added, again, a few years ago, whatever it was, 7 or 8 years ago, is they do a financial analysis, because the only way that, since there's you can't miss a payment.
You don't have a payment. You get a payment.
So you're not going to get foreclosed on
a
loan without a payment. However, if you don't pay your property taxes and your insurance on the house, that is the only way that you can get foreclosed on with the reverse.
Do some of these mortgages, because I know with regular mortgages, but do some of the reverse mortgages just build that into it to where they pay the property taxes and they pay the insurance?
That's an option. For people that have poor credit, it's not an option.
With poor credit, it's not an option. I would think someone has poor credit, the reverse mortgage lender says, okay, we've got to impound your insurance and we have to impound your taxes if they have poor credit.
Yeah. That's exactly what they're saying.
Okay.
It's not, they're going to force you to do it, is what I meant.
Yeah. Okay.
But I've had some people that, and the way they do it is, let's say if I qualify for $300,000, right? My house is worth whatever, 800,000, I'm 80 or 75, pick a number, and I qualify for 300,000. Let's say I have lates on my payments, or I'm late on my property insurance. Then what they'll say is okay, you need what's called a life expectancy set aside. So my $300,000, they're going to say, okay, Jim, what is your property taxes? And a lot of people, it's low if they've been in their home. You know how that works.
Yeah, yeah.
So what are your property taxes, and what is your home insurance, and what is your life expectancy? And they may say, of that 300,000, we're going to take 400,000, not 400, 40,000. We're going to do this set aside, and the servicer will pay your property insurance and your
property taxes.
This is an impound account.
Okay.
Same concept.
Let's do this. I know I want to know the answer to this question. So they evaluate the house at, let's say, $1 million. They own nothing, and they get it at 62, and God willing, they live to be 108. Do they still keep getting money even when it goes past the value of the house, or is there a cutoff? Talk about that. Does that make sense?
Right. So it depends. And the idea of getting money every month, makes sense. But to be honest with you, once people understand how the line of credit works, I've only done one in 11 years that actually got the monthly. The line of credit is so brilliant when you see how the amount you don't work compounds, and it's like the current rate. So if I have a line of credit, and I have customers, like I have a $250,000 line of credit, right? Which is a great safety blanket. That could be like the long-term care, or that can be like the 401k that you wish you got. So your house could be like a financial superhero, in that if I have a $250,000 line of credit and that thing's growing currently at 7% compounded, my access to my equity is growing significantly over time. So what that does, when they added that feature, that makes a reverse mortgage like a financial tool. And financial planners that understand that will use it like another financial asset. Okay.
Interesting.
So the monthly payments is good, but most people want to use it when they need it.
Well, let's say that they got it appraised at $1 million, and the person lived so long and they actually pulled out more than what it was worth. Does the bank keep making those payments to that individual because it's just strictly based on math? And or what happens there? Does that make sense?
Yeah. So there are different payment options, but let's say the person gets it was called 10-year payment. In other words, we're going to give you that payment for the rest of your life.
Yeah.
So the answer there would be, if you lived to be 108, you would get that payment, even if the bank started to go upside down on the loan. And that's what you're asking.
Right.
So if the loan is doing this, or the other scenario, if the loan is doing this, your payments go above your life expectancy, then you continue to get those payments uninterrupted.
So you can actually, this is kind of silly, but you can actually make money, obviously, if you live longer. But that's not necessarily the reason. You're probably not. And that's the reason they do these things.
Yeah. So to dovetail on that same idea, so let's say either because you lived long, okay, here's the value of your home, your loan's going higher than the value of we have a housing scenario where the values drop. Now it's doing this, right?
Yeah.
Now you got a big difference. You don't care about it because you're alive, right? But then let's say you die. So now we're upside down. We're literally upside down. So this is what's called a non-recourse loan. So the lender can only use the house as the asset to pay off the loan.
That's big. I want people to understand what this is going for.
Yeah.
So in other words, if they give out $1.5 million and they only get $1 million back, they can't go after the estate for that additional $500,000.
Exactly. And that's a beauty thing about reverse mortgage. Not only that, but what they'll do is they'll go to the family for sure, and they'll say, you know what? You have the option of buying this house at 95% of the value today.
Really?
So let's say we are in that scenario like 2008, right? Where all the properties are rented at the 2000s. When all the properties dropped, right? So now I'm like way off. I died. My kids now can go, you know what? We know this is a low value market. I'm going to buy that house at 95%. And when the market turns around, then I have that asset at whatever the market value is. So that's really cool. So
Interesting.
that's what I hope people kind of understand with these reverse mortgages is a lot of the negatives have been addressed, and they've really tried to make this a really neat financial tool that has, they're not out to, that has advantages even for
The perfect candidate is someone like I had mentioned, which is a real story, which is someone that had well over $1 million of equity, didn't have any heirs. Tell me who is someone that you would meet? What are the qualities that someone has where you'd go, I don't think this is right for you? I mean, not that it's your decision, but
yeah.
Tell us, walk us through that. Because people ask me, should I get a reverse mortgage? I shouldn't. And I know it's very individualized. I mean,
Absolutely.
So tell me who maybe shouldn't, if there's such a person, shouldn't get a reverse mortgage.
So there's a qualification process. So some people that want reverse mortgages, they don't qualify for enough because they're too young, or the rates are too high, or there's not enough equity in their home, right? So there's a disqualifier potentially just based on the economics. The next thing, the main factor that I would look at is what we've already talked about, and why I learned early to get out how these work in terms of when you die, whoever inherits the home is going to inherit less. Because I've told, I've explained this many, many times. And there's a story that I actually learned that I share is I say, okay, there's two types of kids. There's the good kids and the bad kids. And I've had, kids that'll come in at the end and they'll say, Mom, Dad, you don't want to do reverse mortgages. They can take your house. They own your house, all these standard negatives. But what's really happening is they're more concerned with their interest in what they're going to inherit, because they will inherit less. And one of the main sources of complaints against reverse mortgages is from kids that inherit a home. They didn't know Mom and Dad put a reverse mortgage on the house, and all of a sudden they find out instead of the $1 million house, they're getting a $200,000 net.
Yeah, that makes sense. But I mean, what about so basically just
that would be it. So
just,
what it is,
there's nobody that you would just say, hey, no, you know what? This is not right for you. It's only if they really want to increase and make sure their kids' inheritance is high or they don't qualify.
That's what I've seen in my experience. Those are the two things. Because other than that, if you qualify and you don't, the third one is I don't need the money.
Right. Okay. There you go.
I mean, that's really it, Darryl. It's that simple. I mean, it's like their financial, there's all kinds of financial tools, but hey, I don't need the money, right? So I'm not going to do it.
Well, let's go back.
The main thing that I always, and what's interesting to me is a lot of times you think, okay, that's a big deal. A lot of times the kids are bringing me into the scenario. Guess why? Because they're supporting Mom and Dad, right?
Sure.
They're giving Mom and Dad money in order to make the payment.
Right.
Okay? So many times those are the good kids. Many times what will happen is the senior will say, well, they don't care what I do. And then I get into it and all of a sudden, okay, well, can you explain it to my son? He's the finance guy or daughter. And I've explained it to them and they turn around and want to do it themselves. You know what I mean? So it's a situation where it's all about education, people understanding how this works. And it still comes down to, does it fit or not? In most cases, when it doesn't, it's because my clients will say, well, my kids won't let me do it. Or, you know what, I want to leave this house to my kids. And the kids will go, we don't want the house. But it's just the mentality.
Part 2 comes out next week. Stay tuned, only on the Jones Zone.